Okay, so chapter 14 is all about government revenue and spending. So let's start by defining government revenue and what it is and how it works. So, government revenue. Revenue is the money that a business makes normally, right? So government revenue is going to be the money that the government makes. Guess where that comes from?
Us. Taxes.
Taxes, yes. And I swear this lecture is like 2 weeks too late. It should have been right before the tax deadline, in my opinion. And where do you think they use the money? Any ideas? Yeah, what do they use that tax money for?
Build roads.
Build roads?
The exact word for it is, but
They spend money on public goods and services, right? In some way, shape, or form. And we will touch today on what exactly those are. So, before we start talking what happens with that tax money, we need to talk about what it is, what rules it follows, where it comes from. Okay, so the principles of taxes. There are two main principles that taxes follow, two different ways they can work. The first is the benefits received principle. This says that you should, how am I going to put it? If you receive a benefit, you should pay a proportionate amount for it. So I know this is a silly example, but if we all pay taxes that place for a playground, if you use the swing 25% of the time, then you should pay 25% of the taxes for the swing. And if someone doesn't use the swing on the playground at all, they shouldn't have to pay for it, right? It goes both ways. Everything is proportional in that one. And the other is the ability to pay principal. The ability to pay principal says if you make the money for it, it doesn't matter if you use it, you should be taxed on it and taxed for it. So when I was in college, this wasn't a tax, it was just a charge. Whenever I went to pay my tuition each semester, there was a charge on there for the use of the athletic equipment and the sports fields and all that. Did I ever go to a sports game in college? No. Did I ever go to the gym to work out in college? No. But everyone was charged that fee regardless of whether they used the equipment or not. Okay, so when taxes are set up and put into place, there's a couple of goals that they want to have, a couple check marks they want to put in boxes to make sure the taxes make sense. The criteria for taxation, there's three main ones. The first is going to be equity, which is just fairness, where people who make a similar amount of money should pay a similar amount of taxes. Then there's simplicity. They want taxes to be easy to pay and easy to collect. We can all hop on our computers and do our taxes nowadays, or print it out and send it in the mail instead of going through something super convoluted in comparison. And then efficiency. This is just the concept that the tax does its purpose. It gets the money where it's supposed to be for what it needs to be spent on. If a bunch of money is being lost on the way, then it's not doing its purpose. So there's a couple different routes through which taxes are collected. We're going to call those tax bases. Remember this? Give me just a second. So the main tax bases, the main people who pay taxes. Well, the first one we think of is ourselves, right? We pay individual income taxes. And then there's businesses, right? That's called corporate income tax. Alongside that, we also have the tax that we pay every time we go to the store. It's called sales tax. And the fourth one is when you buy or sell property, or if you own property, you pay property tax. Main places that taxes come from. Okay, but how do we decide what percentage you're taxed on? Well, there's 3 different tax structures that represent that. So the bases are where the money comes from. Structures are the way it's taxed. So the first is the proportional tax. Proportional tax is what you would call a flat tax, okay? The rate is the same on everything. And a basic example of that would be sales tax. What's the sales tax percentage around here? It's probably, I'm assuming it's 8.25%. I could be wrong, but something close to that, at least is what it is. Then we have the one that changes. This is called progressive tax. And this is as you progressively make more money, you progressively pay a higher percentage in tax. And that's how our income tax work, although it's a little more complicated than it sounds. So, more money, more tax. Percentage. And then lastly, we have the one that feels like it's backwards. It's called regressive tax. Even the word sounds backwards, regressive instead of progressive. This means that was a weird noise. The percentage that's being paid in tax decreases as the income of that person increases. So it's less of a change in the way something is taxed, and more of thinking of it proportionally to someone's income. So in simple terms, more money, less tax percentage. And this is when you think of sales tax on basic items, but if you think of it in the terms of rich people versus poor people. So a $1 candy bar, or no, let's do something bigger. A $300 a month car payment for a poor person is a higher percentage of their income than a $300 car payment for a rich person, right? Make sense? That's regressive tax. When you have less money, it's a higher percentage of what you have. And that one's really weird to me. So let's talk about the impact of taxes. Everybody got this? Cool. Ooh. So there's a couple different ways that we'll talk about it. First of all, there's something that's called incidence of a tax. And this is just how it impacts taxpayers. Or the financial burden that it puts on them. I am not writing in a straight line today. That is so fun. We also know that tax is affected by demand, or it affects demand. Everyone, if we think way back, remember we talked about elasticity and inelasticity, where if something was elastic, it could change really easy, and if it was inelastic, it was really hard to make it change. So when we talk about, let's think about it for a second. Elastic demand is demand that
Can change.
it can change. So what would be an example?
Tax-wise?
Not even for taxes, just a product that you would buy that the demand can change really easy.
Fruit.
Fruit.
Due to seasons coming in and out.
Okay, yeah. Fruit. Elastic demand. Prices change, seasons change, it's going to change. And what's something that would be an inelastic demand? People are going to buy it no matter what the price is.
Gas. Toilet paper.
Gas, toilet paper, insulin for diabetic people, right? People will buy those regardless because they need it to get by. So, in the term of taxes, when you have elastic demand, people will buy it less when the price goes up, right? So the people who are selling it are more willing to pay for the taxes to make sure that people keep buying their products. So more taxes are paid by the seller. So things like food products and recreation, things that are just for fun, that's going to be your elastic demand because they want to make sure demand doesn't go down too much when the taxes go up. However, when something has inelastic demand, guess what? People are going to buy it no matter what. So then the buyer has to pay more taxes. They know you're going to buy gas no matter what the price is. So they'll make you pay for the extra tax. They know the diabetic person is going to buy insulin to stay alive no matter what the price is. So they'll make them pay the extra tax. There's a couple other ways that taxes impact things. With resource allocation, actually, I'm going to leave that term out because I think it's weird in this context. Whenever taxes are applied, a lot of the time it will cause demand to decrease. It will shift the supply curve. Whenever taxes make products more expensive to make, demand can decrease. Or if vice versa can happen. If taxes are taken off of a product, demand can increase because the price gets cheaper. Higher taxes also impact the productivity and growth of an economy. When taxes are high, people don't want to work, they don't want to expand their businesses, and it does not help. So high taxes decrease economic growth. And lastly, taxes can be used to control economic behavior. So they can increase or decrease spending. What do you do as a government if you want people to stop buying something?
Jack up the price.
As a government doesn't control prices, at least not around here.
Limit supply.
No, you put a tax on it, right? Remember with alcohol and cigarettes and things like that. Whenever they said, hey, this is a bad thing, we don't think it's good for people, we want people to do it less, they said, we're going to put a tax on it. We'll call it a sin tax, right? Or that's what a lot of people started calling it. And it made people less likely to buy it or less likely to buy as much, in theory. However, if they want you to buy a home, they might say, hey, this year we have an incentive. We'll give you extra money off of your taxes on your tax return if you buy a home. They can do rebates or things like that to make people buy things. Then raise your hand if you filed your taxes this year. No one? No one in here had to file taxes? Oh, wow. Okay. So we'll talk a little bit about individual income tax. So individual income tax, that's the tax that people pay. It starts when you have a job, and they take out something called payroll tax. This is also known as your withholding. I still don't know if I spelled that right. But your withholding is the amount that the company you work for took out and set aside to pay your taxes. And every year, there's something called your taxable income. Which is the amount that is subject to taxes. So some money is left out. If you're paid in cash, it's left out. If, I'm trying to think what else. If you put it into specific investments, it could be left out. But otherwise, most everything you make is considered taxable income. And every year you have to file a tax return to either pay your taxes or receive money back when you paid too much into the withholding. Got a second for this. Okay, we're good? Let's keep going. So, here's a term for you guys to remember. It's an acronym. Is that an acronym? I guess. FICA. FICA. That is the Federal Insurance Contributions Act. So this act, this legislation, said, hey, when we get payroll tax, we're going to use it for these specific things. So the money for it comes from payroll tax, and then it's spent on things like, where'd it go? Social Security, Medicare, unemployment, okay, welfare programs. Let me see real quick if there was a date associated with that in the textbook. So Social Security was introduced in the 1930s, Medicare was introduced in 1966, and unemployment, it doesn't give us a date. Okay, and then a couple other types of taxes we want to talk about. So, I keep losing my spot on the notes. Corporate income tax is paid on profits. So not just the money that a business brings in, but after deductions of things that they spent money on to run their business, that's what what's left over is what they pay taxes on, their profit specifically. So just like when you have a small business or you working as an individual, you have things that you can deduct. If you have a cell phone you use for work, you can deduct it. If you have a home office, you can deduct that square footage of your house. Businesses can deduct things like, oh, we bought new machines, we paid our employee, different things like that. There's also a couple different types of taxes that I want to talk about very briefly. You might have heard of some of them before, might not have. So there are something called estate tax. That's when someone dies and you get a bunch of money or a bunch of property from them and it has to be taxed. A lot of the time it's a very large amount. Like more than $2 million worth for it to be taxed by estate tax. So a lot of stuff is not taxed in that category, just because it's not a high enough amount. There's also a gift tax. So if someone gives you a gift, whether they're related to you or not, that can be subject to tax if it's over a certain monetary amount. And I don't remember what that is off the top of my head. There's also customs taxes or customs duty. That's when you bring something from one country to another, you have to pay tax on it to import it into the country. This is why in airports you can find little shops that are called duty-free, so you don't have to pay the money to bring it in and out of the country because it's in the airport. It's kind of considered the in-between. It's already been taxed. In fact, it's already been taxed makes it more expensive. And then lastly, user fees. So for things like state parks, national parks, to get in, to rent a campsite, etc., you have to pay money. That's going to be your user fees as a type of tax. Okay, now let's jump from all that, the different types of taxes, to the federal government. What does it do with our money whenever it gets it? Everybody got this for the most part? So when the federal government gets the money, it has to decide what to do with it, and it's called federal expenditures. It's just where the government puts the money. There's two kind of main categories for federal expenditures. The first is considered mandatory spending. Mandatory means we gotta do it. We don't get a choice. There's not a change. We always spend this money for this thing. And for the most part, that's going to be the FICA programs that we talked about earlier, social welfare programs. So things like Social Security, veterans benefits, unemployment, food stamps, Medicaid, Medicare, all of those are mandatory spending. The government is always going to put money towards those. It might vary a little bit from year to year, but it's always going to get paid for in some way or another. And then we have what's called discretionary spending. And discretionary spending is where they take money and they give it to somebody and say, put it towards something in this area. Okay? It's less specific about how it is spent. That's going to be things like highways, education, scientific research, so things like NASA, the FBI, court system. The military spending probably also falls in this category, although I will say the book does not mention the military at all as far as government spending, which I find very unique. So all that stuff where someone else decides where it goes, other than the president and Congress, that's discretionary spending. So every year, the president and Congress come together to establish what's called the federal budget. So, like I said, that's the president and Congress. And they make a new one every fiscal year. So when I say fiscal year, that means a year in money, okay? That doesn't necessarily mean 12 calendar months from January through December. A lot of the time, fiscal year kind of shifts a little bit based on things like tax day. From there, Congress takes the money and puts it into appropriations. And appropriations is just like we took this specific amount of money and put it aside for one thing. We just set it aside for it. And then it gets spent, right? From there. There's two different ways normally it gets spent. The first is a transfer payment. We talked about transfer payments a little while back. Does anyone remember what they are? It kind of sounds like what it is. What do you think of when you hear transfer payment?
Isn't it like instead of paying with money, you like give land and deeds and stuff like that?
No, actually. So think when you have money in different accounts and you transfer from one to the other, or yeah, that's the most basic way to put it. But basically, there are no goods or services exchanged. They just take the money and they give it to the person.
Oh.
That's it. So when we got checks in the mail during COVID, the stimulus checks, those were transfer payments. Because they just said, you're a person, here's your check. That's it. And then the other option is called grants in aid. And grants in aid are when money is like sent between levels of the government. So if the federal government takes money and sends it to the state government, and the state government sends it to the local government, and the local government spends it on new roads, or they spend it on education, things like that, that's going to be a grant in aid because it's passed down one way or the other through the government. And the way the spending is impacting the world couple different things. First is resource allocation. So every year when they make the budget, they get to say, hey, this year we want to spend more on this thing than that thing, more on education and healthcare than on military spending, or vice versa. They also, when the government spends money, it does a little bit of income redistribution. So in theory, that's your Robin Hood, take from the rich and give to the poor. They take everybody's income taxes, and then they pay for all of the welfare services. And make things a little more equal. And then it also creates competition with the private sector. So private businesses have competition with the government in creating different goods and services because the government can pay for some of its own goods and services for people. And lastly, I want to say that state and local governments kind of work the same way as the federal government as far as their spending and their budget. It's just a smaller version of it in proportion. And they pay for things like public schools and public safety within a state government or a local government. And that's why some states have state taxes. And so they have more money to put towards that. So yes, that is what I have for you today. Make sure you get your Ed puzzle done, please, because I need them.